What's up, YouTube? Hope you guys are having a good day, having a good week. Hope you're crushing all your goals and just killing it in general. This video is going to be about investing and pretty much how to just get started, because I know a lot of people have been asking me. I know if you follow me on Instagram, I'm posting on my stories like every other day, just because the stock market is going it's going insane right now. Like if you're invested in Tesla right now or anything, you're just sitting back like, what the heck is going on right now? So I've been getting a lot of questions on like where to even get started, because I mean, even 4 months ago is when I started, so I'm a noob. I'm not a financial advisor or nothing. I'm just trying to get my people on so they can start making some money in the stock market. So the thing with stocks is that pretty much the whole world revolves around it. So you know that, I mean, if you just look at any of the charts of any of the indexes, it's always going up. Even when there's recessions, even when presidents change or anything that goes along those lines, it may dip, but no matter what, it's all gonna go up. It's capitalism at its finest. So I highly recommend anybody that isn't investing, just do it. You don't have to put a lot of money in initially, and that's probably the safe thing to do, just to not put a lot in, just to start, just so you can test the waters and kind of get a hang of it and know exactly what you're going to be doing. But I'd say some of the best things that I've learned from investing so far is that you don't realize how quick your money really can grow if you find good companies. You could be sitting in there with, like, I mean, I started with my Trump check, my stimulus check, and so that was $1,200, and I put it in because, I mean, I'm still employed, I'm still working, so I wanted to make a step in a better financial direction than I was going, because at the time I was either putting a lot of money towards, like, you know, and that was only just burning my money up left and right, and it's like, wait, why am I even doing that at this point? Like, I understand it if it's a good release for some people, but that's done for me, especially after I started investing, because it really got me to get my mind towards a better financial future. So I'll try to break it down the most simple way I can, and obviously you'll have to do some more research on your own. Like, I'm not a financial advisor, at all, just trying to help you out. But where to get started is open up a brokerage account. You can either open up a brokerage account, you can open up a Roth IRA. The difference between a Roth IRA and a brokerage account is what you're going to put money into now. You don't have to pay taxes on it until you pull money out. And if you make under a certain amount of money, you might not have to pay any taxes on any of your capital gains. But if you, say, make more than $50,000 a year, it's a different percentage than if you make under that a year. So, and the Roth IRAs are pretty much, you pay into it now, but it's tax-free when you pull your money out in the future. So it's pretty much like a 401k. There's limits to how much you can put in each year. So like the Roth IRA I have is a $6,000 limit, so I can only put $6,000 in each year. And even if you can't put that much in each year, you would want to try to max out, get the most of that as you can, because then when it comes to retirement, you can pull that money out and not pay any taxes. Because who knows in the future, like if you're a long-term investor like I am, like I'm only going to buy into stocks that I hold on for a long time. And if you hold stocks for longer than 1 year, the tax rate on that goes way down. So you don't want to be in buying stocks and then jumping over to the next thing and over to the next thing, because the tax man's going to tax some of that. So it's not really worth it in the end to just be a day trader, swing trader, just any short-term stuff. I mean, there's benefits to it, but there's also a lot of risk to it too. Most people can't time the markets and get ahead that way, but I mean, in the way the market's going right now, who knows what the heck is going on? You could probably do anything at this point. It seems like nobody can fail anyways, and obviously there's probably going to be some heavy dips coming with either the Rona numbers coming up, or with maybe the vaccines don't work as well as they're saying that they're going to work, or maybe people don't even jump on board to get the vaccine, and then stocks that have been like, oh yeah, everything's good, we're cruising there, Rona's gone, it's over, they might have a reality check and then it dips, you know. So we don't know. That's the beautiful thing about it. It at the end of the day, it's all risky, but I feel like if you look into being able to read financials and balance sheets and go through a company's 10Q and a 10K to really understand what the company's about, and they literally have to tell you what the risk is involved, like with how they're pretty much like what the risk of that company going to complete bankruptcy is, like what could potentially hinder their growth or what might limit their growth potential. So you can get a lot of that out of their financials and balance sheets, just to see, you want to make sure that they have a lot of cash in hand and compare that to their total liabilities, because if they got way more cash than what their liabilities are, that means that they're set. Like, not in all cases, but overall, if there's a really large amount of money sitting in cash that they have that they could deploy to any of their debt, their liabilities, then they don't have any debt if they can move that out. But every company is going to have some kind of liability, some kind of debt, just to keep things going, keep things moving. They might be borrowing money from a bank or whatever, just trying to grow, because you can only grow your company if you're taking out loans for other things or trying to grow in that way. So let's get to the first thing before I like ramble your head off. Sorry. First thing you want to do is open a brokerage account or Roth IRA. I have mine. I have my brokerage account is my main one with Fidelity. I have two with Fidelity. I have one with TD Ameritrade, and then I have one with Robinhood. And 2 months ago, I pulled all my money out of Robinhood because there were becoming reports. There were reports coming out that were saying how people were losing their money. Like, people would go into an account and see that their stocks were either sold off or something was missing, and there's literally no phone number for any of them to call. And I even looked at, I was like after I read this thing, I looked it up, I was like, yeah, there's literally no customer service number to call for Robinhood accounts. So like, let's say I had $1,000 in there or something and it magically disappeared. Who do you call to be like, hey, that's not right, I didn't sell this off, or didn't get... If you can't talk to anybody, there's probably something wrong there. You know, that's super sketchy, super sketchy. So no Robinhood. Like, you might see people in other financial videos or anything being like, hey, click my Robinhood link, or, you know, you get a stock, I get a stock. Just stay the heck away from Robinhood. I was only holding on to it so I could do cryptocurrency, and at the end of the day, there's other apps that I could be using for that. So like Cash App, or, you know, any of that. Especially if you want to like buy Bitcoin, I recommend Cash App for all of that, because you can't do crypto with Fidelity. So, but Fidelity is what I use the most. If you see me posting on Instagram, the account, that little graph, it's all with Fidelity because it's been around the longest. It was like actually one of the last to start doing the commission free and all that. So it was kind of late to the party, but they conformed because they had to keep up with what Robinhood and all these other accounts were doing. So second step, you're gonna want to put money aside from each paycheck. Maybe 10 to 20% is what most people recommend. But I mean, really, it's whatever you can afford. Like, the beautiful thing these days is that there's things called fractional shares. So you could literally take $1 and put it into a stock, and then you literally own a piece of that company. So before, you'd have to have commissions, so you're paying like, I heard it was like 25 up to $50 just to be able to put money in. So say if you only had $1 to give, even though let's say that they even offered fractional shares back then, you would have to pay a commission fee of 25 or 50 bucks just to put your $1 in. So you're already behind right there, right? So that all that's gone. Like, it's literally free to open a brokerage account, and you can put your money into literally any company that's listed. So it's a publicly traded one. So I would recommend 10 to 20% each paycheck, but like I said, literally anything can go in there, just as long as it's dollar, and there's even penny stocks in there. But if you're a noob, don't even go near penny stocks, because those are like the most risky of all of them. They could have the biggest reward. Like, you might want to buy a stock that's like 4 cents. Who knows? Eventually it might be like $100 or even $1,000. But right now, the risk ain't worth it, because it could literally go bankrupt tomorrow and your money is gone. You know, so don't do that. Don't do that. And then, like I said, for number 3, research the financials and balance sheets. Like, you're gonna want to learn. Like, there's plenty of videos out on YouTube. Like, I'm not smart enough to break down all those levels for you, because there's other people that can verbally say it a lot better than I can, at least. And but the number one thing is financials. Like, are they making money? Are they making revenue each year? Well, each quarter, really, because each quarter they have to come out with their earnings reports. And let's say that you really believe in this company, but let's say there's somebody else that they're like, I don't know about this, I'll just put money into this, I don't know, I'm just trying to play this just for the short gain, short money. They might see an earnings report, if they miss their projected targets for the earnings, and then they're going to pull their money out. They're going to get scared, they're going to run, they're going to hide, they're going to be like, oh, I'm into the next stock because this isn't doing anything for me. Don't worry, don't play the short game. If you ever see a stock that you're investing in go down and it's in the red, buy the dips. You're going to want to buy when it's on sale, pretty much. So let's say you get in at an entry point of $100 when you buy it. Say that they miss earnings and it tanks down to $80. Okay, you lost 20, right? But if you have more cash on hand, and you're going to always want to have some cash sitting there in case something happens like that, because then you could buy when it dips like that, and then it's going to average down your cost. Like, it'll take more money than what you put in to average down, but averaging down is like the best thing you can do, because then when it does go back up to where you initially bought it, then you gained even more money than what you would have just had just from having it sit there, if that makes sense. Sorry. And then number 4 is going to be, you're going to want to research a company that you pretty much want to get into. Like, after you've learned how to read a balance sheet, you're going to want to start looking at other stocks that have super solid balance sheets. Everybody says Apple is the ultimate king when it comes to balance sheets. Facebook is another good one for when it comes to balance sheets, if you want to look and see how much money they're making on revenues and all this stuff. And there's a bunch of different routes that you can go. You can go individual stocks, where you're just picking one company, one ticker symbol, and then just going with that. Or you can do index funds, which run off of the index. Let's say you want to do S&P index or a Dow index or whatever, but it's managed by someone else, and they're pretty much buying and selling to get you the best return from it. And the good thing about those is that they're safe, because then you don't have to worry about it. Like, they're going to be investing to their best, to the best of their knowledge, to get you money, because it makes them money in the end. So those also aren't super high growth things. Like, if you put money in there, don't expect to be getting like Tesla money right now, you know what I mean? But the thing that they do to try to keep people into those funds is that they're safe. They're the safest things you can get into, because it's always going up, but it's at a slower rate than other like growth investments. But they also pay out dividends. So, like, based on however many shares you have with the company, you might be getting like 20 cents per share back or 50 cents per share. Like, it all depends on the company, and it all depends on the dividend payout. Some stocks pay dividends, some don't. That's something that you could look into. But I mean, that's one way that if you buy into a stock, it's guaranteed money back every 3 months, because it's either going to pay you quarterly, monthly, some of them are even annually. So you got to be aware of what you're buying into. If you're like, oh, I got this dividend stock, and then you're expecting a little bit of money out of it in 3 months, but it's only an annual thing and they only pay it out annually. But the things with dividends is that there's no guarantee on them. Like, they literally could be gone. Like Nike, I'm pretty sure Nike's, oh no, I think they got rid of it. I think Nike and Disney were originally had dividends, and then Rona hit, and then everything went down, and now they aren't paying dividends. But I mean, obviously, when they get their growth back, they'll be able to start paying more money out. But I strictly stick with individual stocks, just because I like the level of risk with it. Like, if I'm doing enough research on the companies and stuff myself, and I trust that it's going to be around for 5 to 10 years, then why wouldn't I just load the boat on what I think's going to work? Because it'll have way more gains than playing it safe. And since I haven't started investing until my 30s, it's like, well, I'm already behind and I kind of need to catch up a little bit, you know? And it's a little bit more exciting that way. But just know that it's definitely a lot more risky with individual stocks. But I mean, if you're doing your due diligence and going into all the financials and the balance sheets and reading the 10K, 10Qs, I mean, you'll know what level of risk you're trying to do. And then let's see, where are we? I don't even know where we're at. I'm just rambling here. Okay, and then number 5 would be put your money into whatever you've researched and what you've found to be the best fit for your money, really. Like, you don't have to clock in. You ain't gonna get fired. It's a beautiful thing. Like, you literally just put money in. You own a piece of the company. If it does well, it's gonna make you more money, and you can just reap the benefits. You know, it's a beautiful thing. I would suggest literally only putting your money in for the long term. One, for the tax thing, because you won't be as taxed as much for capital gains when you're pulling money out. I really suggest something that's going to be around at least 5 to 10 years, hopefully forever. But everything, no matter what, it's always going to have a growth limit. It's going to get to a place and it's going to consolidate, and then it'll get a lot slower for the growth. It's just finding out where that's going to be, and then you might be able to reassess and take some profits and be like, okay, well, is this going to stay around? Is this potentially going to drop? Is this going to be something that goes away in a couple of years or something after you've held it for like 5 to 10 years? But it's all going to depend on so many things. But at the end of the day, you just really want to hold and like buy the dips. So that's going to be number 6. You're going to want to hold on tight, because if you are in growth stocks, which is like companies that are still growing at a rapid rate, they still haven't like consolidated and stayed at like a consistent range for a long period of time, that you're just going to want to hold. If it goes down and you potentially are losing money, anytime you see red means go. Like, pretty much buy, unless it's like something happened with the company where they literally are losing like a lot of money. Say they lose their CEO that was doing so well for them, or just something really bad happens with the company. That's when you want to get the heck out. That's when you want to run, cut your losses. If you lost money, forget it. It's like rolling the dice at that point. Like, you made a mistake, they made a mistake, whatever. There's so many levels of whatever could have happened. But that's something for you to assess. Like, but don't get cold feet just because you see it go down a little bit. If anything, think, hey, this is Black Friday came early. That's what I was saying when it was dipping so bad in September and October, because Rona was going up, and then between the elections and just crazy stuff was going on. Everybody was getting panicking. They were all panicking and selling out of stuff. So, I mean, stuff dipped pretty hard. And I was able to buy into some stuff that lowered my average cost. So then when the election was over and everybody like got the vaccine news, everything flew up. And that's where it's at right now. So it's just been crazy how fast everything's going up right now. And to be fair, like, I want to just put a thing of caution out. A lot of companies right now are at all-time highs, and it might just be because everybody is thinking that Rona is already over and done with just because there's vaccine news, which I personally don't believe is the case. That's why I really haven't been buying into more stocks right now. I'm just letting it ride, but I do have cash on hand that I'm just sitting on the sideline waiting for when it does dip, because when it dips, then I could buy more and then potentially lower my cost average or buy more shares at a cheaper cost. So at the end of the day, that's up for you to decide. And then I'll tag some books that I read and some audiobooks that really helped me understand the stock market a little bit more, because I know this was all just rambling. I mean, like I said, I'm not a financial advisor. I'm just trying to put you guys on. So let's just go back over it, because I know when I get going on a tangent, it's kind of like all over the place. So you're going to want to open a brokerage account or a Roth IRA. If you're just trying to get into stocks and you aren't worried about like retirement right now, brokerage account. Just number one, brokerage account. Number two, you're going to want to keep money, save money every paycheck, 10 to 15% of your check if you can afford that. If not, whatever you can afford, because there's fractional shares. So that means you could buy, like, okay, for an example, Amazon right now is like at $3,100 for one share. For one share. So that's going to be something super intimidating. Like, people are going to be like, I wish I could own Amazon, but I'm not going to pay that much. You could literally put $1 up to however much money you want into that stock, and you own a piece of it. So if you put $1 in and that company goes up, if Amazon goes up, your money goes up with it. So you don't necessarily have to you don't have to buy one full share anymore. Like, you just buy fractionals and you're good. So like, say you put $200 each paycheck and you get paid twice a month, or say maybe you get paid weekly, then you could put that money into Amazon over time, and then it'll eventually be one share. You don't necessarily need to buy it all out at once. You don't need to start with a lot of money, not anymore, thankfully, because it seems like it was kind of set to deter people that didn't really have money, but now it's kind of set up that, like, people like me, I don't make a lot of money. I may got the Calvin, but you know. Anyways, then you're going to want to research the financials and balance sheets to be able to know, okay, this company has money in the bank. Compare that to their liabilities. Like, are they potentially going to have those people that they owe money to come after them and be like, hey, we're going to need that. If they got enough cash to pay off those liabilities, you're good. And then research stocks that you want to get into. There's a bunch of safe ones. Like, I mean, and you know what's safe by now, at least, like, what's something people are using every day. Like, everybody has an iPhone. Everybody's using either Macintosh or Apple computers. Just break it down that way and think of like things that you use on a daily basis, that your friends use, that your family, that literally everybody's using, and then research those companies and see which one might be the safest for you to get involved with. There's plenty of videos on YouTube of like companies you might want to look into or things like that. I'm not a financial advisor. I'm not one of those people trying to get in on that boat. I'm literally just doing this just to help y'all get started, really. Like, this isn't going to turn into a big financial channel. Like, I'll definitely put some out if people have some questions about stuff, but but I want to stick it to like other building methods and ways that we can better ourselves. And there's definitely a lot that you can do with that in stocks and financially and stuff, but there's so many other people that are way better at this than I am, so there's definitely research that you guys could be doing with that. And then really that's pretty much it. Like, just buy into companies that you know aren't going to bankrupt, and buy into companies that you know are going to be around in 5 to 10 years. Like, do you think Disney is going anywhere, even though the Rona is still like full blast a lot of places? And California, I'm pretty sure the California park is still shut down. No, because they got ABC, they got ESPN, they got all these other things. Like, Google's gonna be around forever. Like, there's plenty of companies that are gonna be around for a very long time. So I would consider looking into those before anything. Don't just jump into like penny stocks thinking, oh well, if I just load the boat on this, I'm gonna get so much money that then I can buy other things. No, don't. Play it safe when you're first starting out, just so you know what you're doing. And then once you get a better feel for it, then maybe reassess the level of risk. But don't think you know everything. I clearly don't know everything yet, but I've put so many hours. Like, this is all I'm doing now, especially since I'm not going to concerts every other day, you know. I literally only have time. I'm just sitting on my couch. I'm watching conference calls of the companies that I'm getting into, or reading the 10Ks and 10Qs. Some of them are really long, pretty much mini books, to know exactly what the company's doing, where the projections are, what they're trying to do in the future. And I feel like if that's all I need to do to learn a bit about the company and put my money in and make more money, I don't have to call nobody. I don't have to do any work outside of just researching, and then I use my job to put that money I earned into something else that's gonna hopefully make me more money. It's really that simple. If you made it this long, I appreciate you so much, because I definitely ramble. I'm not the best talker on the planet, but I'm working on it. Anyways, like I said, I appreciate you so much. If you haven't liked and subscribed, please do. It helps out the channel so much. And as always, please don't feed the zombies. Have a good one.